Hey guys, it's that Dividend guy coming at you with another Robinhood portfolio update. Happy Tuesday. Hopefully everybody's having a GGD, a great green day in the market. You know I always wish the best for my viewers and subscribers. So for today, we're going to go over the overall portfolio value. Of course, the value by the metrics, the buying power, the individual stocks and how they are performing. See if we still have any deals. Looks like we're having a little bit of a recovery right now, but hopefully stocks aren't going up too much because I want to take advantage of those low prices. And then, of course, we're going to take a look at the watch list and see what stocks are on there and what prices I'd buy those at. So, jumping right in for today, we are up around $240, about 0.5% in the green. For that 1 week mark, we are down about $5,000 with around a 9% loss. Then that month mark, we are down $5,100, a 9.14% loss. Then that 3 month mark, we're up $2,200 with a 4.6% gain. Year to date, we are up $1,400, a 2.87% return. That 1 year mark, we are up $8,300 with around a 19.5% gain. And then all time, we are up $24,000 with a 93% return. So over the long term, guys, we've made really good money. Short term, anything can happen. Tariffs, political news, bad news, etc. Earnings reports can kind of jade early, recent performance as well. So overall, guys, we're doing really well. But of course, in the past 3 months to 3 months, it's been pretty rocky, which I'm sure everybody's portfolio is pretty much like that because of the tariff news. So that is expected. And that means that there are opportunities within this market too. So that is a good thing. So jumping into realty income, Dividend Aristocrat pays me every single month. The goal for this company is alone to supplement my income, which will take a while. But as of right now, it's at $53.50. We have 5 shares, $267 of market value. Average cost is $51.75. About 0.5% of the portfolio is in realty income. Today we're up $2.80. Total, we're up $8.60 with a 3.3% return. Dividend coming in on April 15th of $1.34. So guys, this is a monthly payer, so every single month on the 15th I get paid by this company. One of the things that I love is that normally this does not react the same way as stocks because it's a REIT. So it's a little different of a classification, and the difference is their business is set here in America. There's a little bit, I think, in Canada, was it Colorado? But there's a little bit of Canada and maybe in Puerto Rico too. They've done a couple acquisitions, and I haven't, paid deep attention to where everything was at that they acquired. So there might be a little bit of business outside the U.S., but mostly it's here in America. So they aren't. I think it's mostly California and Texas, I believe, and then a couple Midwestern states as well. But overall, it's very centralized in America. So I don't see this getting as affected by the tariffs. Now, some of the companies that they rent from, that they collect from, definitely do have some exposure and would probably drop. But I don't know if that would really affect their rent, given that they even got a full rent check during COVID, and this isn't necessarily an economic shutdown, it's an economic change. So I think overall, realty income is going to do fine. And honestly, I'm kind of disappointed because I wanted to buy more realty income. It's one of the lower priced stocks in the portfolio, but my average cost is 51, so it's near enough that I'd probably purchase it. But I always try to go below my average. Then, of course, we got Altria, the biggest dividend payer in the entire portfolio, up to 56.34. We have 320 shares, 18K worth of market value. Average cost is $47.27. 35% of the portfolio is in Coca-Cola. Today we're up $200. Total, we're up nearly $3,000, up 19% with a dividend coming in on April 30th of $326.40. So guys, this stock is the golden goose that just keeps laying eggs. Now, Altria has been sideways for a long time, so a near 19-20% return is huge for them. But they wrote off Jewel, that's no longer being a lagger on their balance sheet in their business. And a lot of times when there's economic issues, people smoke more. So, I mean, honestly, bad headlines, bad news, tariffs, COVID, etc., any big change in the market, they may fall, but just like with realty income, they are more American based. Altria is American smoking, and then Philip Morris is pretty much everywhere else. So I'm not surprised to see Altria down. I don't know how Philip Morris is doing on the tariff news. I'm assuming it's worse. But overall, guys, this is the main goal of the portfolio. This month's dividends buy next month's company. So Altria buys Apple, AbbVie buys Visa, and then Visa buys Coca-Cola, and then Coke will buy Apple, or Altria, excuse me. Coke will buy Altria, and then, Coke will buy AbbVie, and then AbbVie will buy Visa eventually. Something like that. It'll just keep going down the line. So one will buy the next one. And as of right now, Altria pays me enough to buy a share of Apple forever, almost two, and or an Apple and Google share. So together. So it just depends on what stock is up, what stock is down at that point when it pays. But this is the overall strategy, is dividends buying me more shares so my income compounds. So next up, we've got Coca-Cola sitting around $70 a share. 15 shares, $1,000 in market value. Average cost is around $61 per share. 2% of the portfolio is on Coca-Cola. I'm surprised to not see it as down as other companies because I know they do a lot of international business. In fact, from what I've read in their proxy statements, they do more business everywhere else than they do in America. Mexico is huge for them too. Today we're up $20. Total, we're up nearly $140 with a 15% return. So I'm surprised that they weren't more affected by tariffs. I mean, if you look at the week to month, they're down a little bit, but they're not down like Apple, Visa, or Google. So interesting to see, even though I would assume they're affected by tariffs, they did not react the same way. Next up, we got Apple, which did get affected pretty heavily. 12 shares, around $2,200 of market value. Average cost is $218, so still a massive buying opportunity here. 4% of the portfolio is in Apple. Today, we are up $12. Total, we're down $430 with a 16% loss. Guys, this, I think, overall is the company that's going to be affected the most and the longest by the tariff news. I would not be surprised if, depending on how China reacts, like I know they matched us in the tariff issue, but depending on how they react, it's really going to affect their business. They do a lot of business in China and overseas. So for their chips for their iPhones. So it'll be interesting to see if they decide to build here in America or if they keep outsourcing that to a different country. It might not be profitable for them to do that anymore, or it might hurt their profits so much that they decide to make centers here in the U.S. For their iPhone chips, or they might just make them themselves. I'm not 100% sure, but only the future will tell. That's part of why this is such a cool event, because every individual company is going to react differently. So like, say Apple's margins are, I'm making up margins, but let's say like they make 50% on an iPhone and it'll only cut 7% into their overall profit, so they make 43%. They decide, you know what, it's worth the tariff cost to just keep doing what we're doing. There's no reason to it's cheaper to just pay the tariff versus build a factory to make our own chips, and odds are ours wouldn't, out of the gate, wouldn't be as good. So they might just pay it. Or other companies might say, oh my god, they're cutting 15% into our profit margin. We're only making, after that tariff payment, after the cost, we're only making 6%. And that's going to really destroy our profit margin, so we need to build here. So it'll be interesting to see how different companies decide to maneuver the overall tariff, the tariff news and how it affects their business. It'll probably affect them all similarly, but not the same. So I'm interested to see how Apple performs. It does look like the overall market, though, has bumped up a little bit, because it got all the way down to 184, so it's still relatively at its low, 175. At like 3 a.m. it was down to 177, and now it's back up to 182. So it's already starting to come back up a little bit, but it doesn't look like it's staying there. So as long as I can buy it below my average cost by Friday, I really don't care. But the lower the better, right? But I think Apple's going to be the long-term, this is going to be affected the most. So I think the buying opportunity for Apple, or a relative buying opportunity, is more likely than the other companies that I have in the portfolio. I think Apple's going to be more affected than Visa and then by Google, but it's hard to say. I know the shift down was bigger. Well, it was about even, but I believe the shift down was a little bit bigger for Visa than it was for Apple, so both of them would be buys. Google is right about where it has been, so comparatively, Apple and Visa are better buys for me right now. Next up, of course, we got AbbVie at 183, down $3 today. It did get affected a bit. It's down 12%, but it needs to be down like 57% for me to buy anything. So 95 shares, almost $17,000 of market value. That's been all the way up to 20,000, but average cost is $95. 34% of the portfolio is in AbbVie. Today we're down 236, total up 8,300 with a 2% return. So, guys, I love AbbVie. This is one of those that it eventually will get back down to my average cost, but it's going to take a while. So this is one of those that I want to buy more of. If it dropped down to $100 a share, I'd buy it, but not at 183. I'm not buying it at a 90% markup. Then we got Visa at 318. This dropped pretty heavy too. I was kind of surprised on the tariff news. It dropped 8%, $30. So it's a good buying opportunity here. My average cost is 47, so I have a $27 upside now on my share count. But I have 35 shares, $11,165. Around $350 is my average cost. Around 22% of the portfolio is in Visa. Today we're up $240. Total we're down about $1,000 with an 8% loss. So guys, as of right now, Apple and Visa are both buys for me. Then, of course, we got Google sitting around 150, which is kind of where it's been at. Like, it's been down, but it's been down for longer than the tariff news has been out. So that's happened within the past week. So it's down another 5% this week, but like year to date, it's down $40. So it's like Google was already down at a low price before the tariffs. It's just a little bit lower versus companies like Apple and Visa, which were at like 220 and it's down to 180 for Apple, and then Visa was at 340 and now it's at like 320. So the dips in those other companies are more vicious, and I feel like are going to last longer, where Alphabet had issues before the tariffs. So I think out of my three biggest goal for my three biggest positions, Google's been the least affected. I think Visa's been the most affected as of like the news wise, but I think Apple long term is going to be the most affected and go down the lowest and have the most swing when it comes to the news. Right? They're all going to be affected, but I feel like just because Apple does so much business over in other countries, I think they're going to be the one that's the most affected. So as of right now, they're all three buys for me. And I'm hoping at the end of, well, I know by the end of this month, I'll get paid by Altria. I get paid on the 30th, so it'll technically probably be the next month, because normally when the dividend hits, it hits at the end of the night, or it's like midnight or something. So I probably won't be adding to it technically in April. It'll be March, May. If I knew my months. But it'll probably hit in May, so I'll buy it probably May 1st or May 2nd, whenever the weekend is over. And the first day of trading is open for that month. But as of right now, I plan at 326. I can buy almost 2 shares of Apple, and that'd put me at 14. So that's kind of the goal, is to just at least buy one. I've been buying one a check, and I might not be able to do that because I'm getting a tooth removed in a couple weeks, and it's going to be like $1,500. So like for personal reasons, I might just use dividends this month, and that'll be the first time this year, but I'm still staying on track with the goal. Like the 1 share of Apple would be 12 for the year. I started off with like 7 or 8. So my goal was 20 shares of Apple by the end of the year, and I will definitely hit that. And honestly, Google's starting to get up there too. Like Google hasn't been the main focus, but I'm already $1,000 plus in Google. So even with the bad news. So guys, with that being said, I just want to say thank you so much for watching. Remember to hit the like button on this video. It helps every single day that I post. If you hit the like button, it does help the video. It does help the channel. It helps more people see it. It's super important. Then, of course, hit the subscribe button if you guys want to watch me build my wealth. Guys, I love when big market corrections or crashes happen, because it's just proof that, like, turbulence is a good thing, but your temperament is truly what makes you a good investor. I like having to do this live because it forces me to ground my feet, not get nervous or scared. Like, I love this, but it's so hard. It's easier to say, like, I'm grounded and I know what I'm doing and I'm buying my companies. It's so much harder to do that than it is to just sell out and wait. Right? So I'm not following the crowd. I'm beating to my own drum, and this is how I plan to make money in the market. Right? My dividend strategy does not change unless a dividend gets cut or a management changes that decides to cut the dividend. Overall economic scarcity is not going to change my opinion on my companies. So there's three things that are going to change, right? Change whether or not I own a company. The management, say like a new management team comes in and they really change the business or change the dividend or something like that, change capital allocation, that would make me think about selling out of a company. Next is if they cut the dividend to a point where I can no longer buy the next month's stock, or economically the business doesn't can't sustain the dividend payment. And then three, if I find a better opportunity. Let's say AbbVie cuts the dividend to 75 cents and I don't know, Starbucks pays better. Starbucks can give me a share of Google every single month, at a better rate than AbbVie can. And I think the dividend's going to grow faster and the economics of the business are better. I'm going to buy Starbucks, right? So those are the reasons. Management team, dividends cut, or I find a better option that I like economically better than the one I own. But as of right now, I don't see that with any of my companies. So I'm holding for the long term. I'm going to keep buying more at these low prices, and we're just going to keep rolling, guys. So thank you guys so much for watching, and I'll see you guys tomorrow with another Robinhood portfolio update. Take care, guys.